Toby, do you want to maybe start in on some of the business provisions? Because I know that there was a lot of changes as far as our C corps
Yeah,
go, as far as our flow through entities go, and everything. But the first thing I was looking at here was, are they going to change the rates of tax for corporations? That was
there
my
was a lot of talk about lowering it for U.S. companies and things like that. None of that made it in. What they ended up doing is nothing with regards to C corps. C corps, the tax rate is still 21%. It was permanent before. They didn't have to do anything to it. They just didn't do anything to it. So that's the first one: is the more things change, the more things stay the same when it comes to C corps, which is 2017 Tax Cut and Jobs Act. They took all the corporate rates and said, no, it's 21% flat. Used to be 13 up to 39, and now it's just 21%. We don't care. Flat tax rate on net profit, and it's not apparently not going anywhere. The things that would have gone away, and it's the cohort to the 21% tax rate for the C corp, was for pass throughs, and that's your 199A deduction, called qualified business income deduction, and it's a 20% deduction on income that flows through to the owners of sole proprietorships, partnerships, and S corps, not C corps. C corps pay their own tax, but the idea was, hey, we lowered the corporate tax rate for them. Let's give let's give tax relief to all the smaller businesses, and that was going to come back, or was going to be eliminated at the end of this year. So that was a huge one. Where, let me just put it an example. Let's say you're a plumber, you make $100,000 of net income out of your S corp. Instead of being $100,000, now it's $80,000. Right? There's some other caps up to your taxable income and things like that, but that's it in a nutshell. Is I get a $20,000 deduction just for being me, right? When I have a flow through, or if you're a sole proprietorship and you make $100,000, it's $80,000 of taxable income, and that was going to go away. And so it was set to expire in next year, and now it's not. Now it's permanent. So that's a pretty big one for all you guys out there that are businesses. And just keep in mind that there are some phase outs. One of the big ones is a specified service business. So Scott and I, for example, in accounting or legal or engineering or tax, we are specified service businesses, which means that there's a phase out, and that phase out is absolute. They did increase the business phase out. I think it's 75,000 for single, and 100,000 is where it starts to phase out. And I believe for single filers, the phase in starts now at 197. 197. There's $50,000 phase out, I believe, so it goes away at about 247. That's this year's index for inflation. If you're married, I think it's 390, 394 and some change, and it goes to 494 and some change. So you're always going to look at those. There are phase outs for those of us who are in specified service, which just means you got to be aware of it. Maybe you're using a C corp in conjunction to make sure your taxable income stays below a certain threshold. But again, that's like doctor, lawyer, accountant, consultant, entertainer, all these things where it's really just you. They say, if you make too much money, we're going to phase it out. So you got to be a little careful. But for everybody else, for just a regular old business, this is a huge deduction that is now permanent. I don't want to underscore that or take away from that. That's pretty big. It's a part of our ethos now since 2018, and it was going to go away. And that would have been painful if it had for a lot of folks. So this is fantastic that they extended that.
Yeah, I think that, yeah, the QBI for sure, because when you go to set up, let's say you want to go set up a new business today, and you look at all the different options available. Without this QBI, the C corp would be probably our default for a lot of the businesses, because it would be taxed at 21%, and so that little 20% deduction on the flow through entity basically was a way to equalize the flow throughs with the C corps, and so it gives us a lot of flexibility. But like Toby mentioned, if you are in one of these specified service, trader businesses, be aware of the phase outs, because there are planning opportunities around it. Maybe, if you're around that 490 or 500,000 complete phase out as a married couple, maybe you do set up a C corporation to take money off of your personal return. So just be aware that this stuff is in play as far as your choice of entity. Um, but Toby, I was thinking, I mean, the one thing I was more concerned about, I mean, I thought that they would do the QBI to keep that in place, but what are they going to do as far as like all the depreciation rules, all of the
Yep.
Section 179, is all that stuff going to stay the same? And
This is the
I'm
one you're
kind of,
hearing about. This is the
yeah,
one all.
I'm a
Yeah, this is the big one.
depreciation nerd. I like to have people be able to accelerate the purchase of, assets that they'd have to take over 5 or 7 or 10 years or whatever it is. And so that was what I was curious about, because the depreciation this year under bonus was going to be 40%. And so
Yeah.
that's not that good.
And let's hit
So
on what those are, because there's really two
yeah,
provisions
yeah,
that are affected when you talk about accelerating depreciation. And the fancy way to say this is the IRS says things have a useful life, and you write them off over their useful life. So if you have a piece of equipment, it might be 5 years, then you write it off over 5 years. And most people say like, oh, it's $100,000, you're writing off $20,000 a year, even if you paid $100,000 up front. So what we're really talking about is getting a huge deduction in the beginning. Can you do this with pieces of real estate? Yes, you can, because you can break the real estate down from its structural components to its personal property. You can write off that personal property if it's less than 20 years. I can write it off in 1 year under the new law. Under the old law that it was set to expire, it was dropping down. So it used to be 100%, then it went to 80, then it went to 60, and this year we're at 40, and then it was going to be gone in 2 years. It was going to go to 20, and then it was going to be gone. What they did is they said, it's 100%, knock it off. Anything that has a useful life, less than 20 years, you're going to get to write that off in year one if you want. You could write it off over its useful life. You can opt out of that if you don't want the big tax deduction up front. And there's cases where somebody's paying such a small amount of tax, they're like, no, spread it out. I want to get the most tax benefit as I can, and I'd rather it be spread out over 7 years, 15 years, or 5 years, whatever it is. I'd rather spread that out because I get a better tax benefit instead of creating a loss situation or really low bracket write-offs. But this was a big one, and that's the first one I just mentioned was 168K. That's the bonus depreciation that so many people are focusing in on real estate, because you do a cost segregation on a property and you write off all that personal property. In some cases, we've had folks where they wrote off 90% of the value of a property. If it's mostly land improvement, they're writing it all off in year one. That was going away. And it was extremely painful this last year. Like, we've seen the real estate market really slow. It's been really slow. There's a number of reasons for it. This is one of them. And so by putting the 100% bonus depreciation and giving people a tax incentive to buy real estate again, all right, that's great. The other provision that you need to pay attention to is 179, which is, so I call it Section 179. It's also a permanent change. And what that allows you to do is write off equipment immediately. And this is where you hear about people writing off their Range Rover and stuff like that. Vehicles that have over 6,000 gross vehicle weight qualify as equipment. And if you're using it more than 50% for business during its useful life, you get to write off the entire, like you could write it all off in year one up to, there's a phase out, but you can write off up to 2.5 million in deductions under Section 179. There's a phase out. What is a phase out? I think it's $4 million and above, you start to phase out. So if you're too big of a business, you start to phase out. Or if you have too many expenses for equipment, you're phasing out. But this is a great one. And one caveat on this, the reason you don't see all the real estate folks jumping all over 179 is it can't create a loss. 168 can create a loss. So those two provisions are like the 1-2 knockout punch. 168K is anything below 20 years useful life. 179 is equipment, which includes things like off the shelf software in computers and peripherals, business vehicles if they qualify, and certain even building improvements like an HVAC or roofing. If you're in commercial property, you can do under 179. Most people, though, are gravitating right over to to 168K. And all those real estate folks, they've been salivating for this. They were griping all the time. I deal with it because I talk to hundreds of them every quarter, and I go to all these events, and I'm like, this was the one thing that I kept getting asked. Toby, what about bonus depreciation? Toby, what about bonus depreciation? And boom, they came through. And hopefully that helps our real estate market. If you're an investor, this is a huge one for you. If you're an individual and you're just buying a house, this isn't going to affect you. But if you are a landlord, whether it's commercial or residential, this thing is huge.
Well, yeah, and I want to mention one thing that you said, and you mentioned something about it, if you want or if you choose, as far as the bonus depreciation or 179, and that's real important because you don't have to use this if you don't want to. And somebody would say, well, why would I want to wait? Why wouldn't I get it all deducted today? And this is where the individual comes in. So I just opened up a new business and I bought $10,000 worth of computers and I don't have any income this year or very little income. Why do I want to take a full $10,000 deduction this year when I could maybe defer some of it to next year when I'm going to be making a lot more and being in a higher bracket? So don't think that just because you can get this 100% bonus depreciation or you can get Section 179, that's the way you need to go. For most of us, it is, but not all of us, and not every situation would we want to elect the 168 or 179.
And it may kick out, may create a loss situation where it's not going to benefit you. We're going to talk about excess business loss limitations, but also 179, just the inability to create loss. It may be that you're looking at it going, why would I want to do that? I'd rather have some income hitting me. And maybe it's flowing into your 12% tax bracket and you're like, I'm fine with that. I
Mm-hmm.
don't need to go to zero. Gosh, I wish I had a nickel every time somebody says, how do I pay zero income taxes? And I'd be like, you don't really want to. Number one, your audit risk goes way up. And number two, like, I'm okay paying 10%, 12%, small percentage. I don't want to be in the 37% tax bracket. But something around that below 20%, I'm actually pretty happy with, and most people are. And they're sitting there doing the analysis going, well, I could I could save myself this much tax this year, or this much tax, a much larger amount over the next 3 or 4 years if I spread it out. So you want to do that analysis. You don't want to just knee jerk say, let's write everything off and create loss when we don't need to.
Yeah, yeah, and that's on the flow through entities. As far as what we can do with some of the depreciation. Obviously, it applies to C corps, but the thing about the C corps though that I like is what happens if you sell the stock. This is something that a lot of people just they don't
This is
have any
huge.
idea about capital gains and whatever. And what's the big picture when you set up a corporation, right? That you're
Yeah,
going to issue some stock. What is this, qualified small business stock that we certainly hear about?
this is another one that has now been made permanent and increased. So it used to be that small business stock you could buy. There's rules on how many shareholders and how much capitalization there can be, but for small businesses that are going to sell, hey, I'm getting into an area. My intent is to eventually liquidate. I'm going to hold it at least 5 years. I'm going to build up the value of this business, and I think I'm going to sell it to, either a target. Maybe I'm going to private equity, whatever the case may be, where you have some idea that I'm going to exit in 10 years. Then you may want to be a C corp because qualified small business stock, and it could be an LLC taxed as a C corp, but there's an exclusion of $15 million of capital gain, or I believe it's 10 times the income or the basis of the stock. Excuse me, 10 times the basis, but a minimum of 15 million of capital gain exclusion. So if I'm setting up a business, I set up this whatever it is. Maybe it's my plumbing shop, and I build it up to become a $3 or $4 million business, and I don't use this and I don't qualify, maybe I'm an S corp, maybe I'm a partnership, and I sell, then I'm going to have $4 million of capital gain inclusion at a minimum. If I do this instead, I would have zero. I would have a complete capital gain exclusion. I wouldn't have to pay tax at all. And I've seen some pretty big ones with these. I think the largest was about a $40 million sale that the basis was high enough to where they didn't have to pay any tax. It was right around four, and it was pretty interesting. So this one is pretty big, and I believe it's indexed. I'm not certain of exactly when it's kicking in. I think they just extended. I think it's 10 million, and then it goes up to 15 million. It could be next year, could be right now. I'm not 100% certain, but what we know is that qualified small business stock is going to continue.
And that's really really important as far as when you're setting up the business. This is one thing that I think a lot of people miss out on, is that they think where they're going to set up and maybe how they're going to run it, but they don't think what they're going to do at the end. What's your exit plan? And so if your exit plan is like Toby mentioned before, maybe Toby and I have a business and our plan is to sit on it for half a dozen years and then sell it off to somebody else. Well, we need to be looking at, if each of us put in $1 million and now we're going to take out 5 million of profit, right, and on the sale, we've got a $4 million capital gain that we have to pay, or don't have to pay if we understand the small business stock issue. So to me, that's before you even set the business up, understand what happens when you sell it, just so that you can maybe mitigate some of the tax disadvantages, on the capital gains.
Yep, and I'm just looking at it. It looks like it's effective upon signing. So the new amount is going to be now. But one other thing that's of interest is the qualified small business stock used to be a 5-year holding period. Now, you what they did is they did a phase in, so you can get half of it up if you hold it for 3 years, 75% if it's 4 years, 100% at 100. So it used to be a closed door. So if you set up a business, again, use the example of a plumbing business, and 3 years later somebody gives you an offer you can't refuse, $4 million, you're going to get half the exclusion. So you got at least 2 million is not going to be taxable, then the other 2 million would be. So at least you're getting something. This new law does change that, and so it looks like it's going to be good for those businesses that again are intending to sell for sure. But with all things, make sure you're talking to your accountant, talk to somebody who knows and knowledgeable and can run some numbers for you, because people are really fearful when you're dealing with the C-Corp of this double tax. It's not a big issue for me. I always look at it saying, worst case scenario, you're issuing out the profits as a dividend, as a qualified dividend in the United States. So it's taxed at your dividend rate, depending on what your income is. It could be 0, 15, or 20%, 23.8 if you add in, depending on how you hold it and in your position. But yeah, I think you're going to get hit with the Obama tax as well. But that's a significantly lower amount than your ordinary income for most taxpayers. So you could always do the math to make sure whether this makes sense. It's interesting to me how many small businesses set themselves up and the accountant instinctually says S Corp or an LLC tax as an S Corp, and they don't actually say, what is your intent with this business? And if somebody says, I'm going to build it up and sell it in 10 years, or I'm building it up and my plan is to run it for 15 years and then sell it, that one little statement right there puts you squarely within that qualified small business stock, and it could save you millions of dollars in tax on your exit if you do it right. And you can always convert too. Like, again, there's a holding period. If you did it wrong and you're like, Toby, oh my gosh, you just hit my situation, my accountant, I want to punch him in the neck. No. If as long as you meet the holding periods, even if it's something that was set up, you could change it. And then you have a holding period once you become a C Corp, but that's a big one. Scott, I do want to go back to kind of that 100% deduction we were talking about. We were talking about 168K and 179D, and there's also another one called qualified production property that is there for these factories that the administration is trying to encourage to be built. So if you put in like a floor in non-residential real estate for used in the production of like a factory, that's 100% deductible as well. So I just want to point that out, that I said there's two, 168K and 179, and there's also this qualified production property. It's anything that's put into play after, I believe, the inauguration date, which I think was January 19th, 2025. But I believe it is temporary. This is not a permanent provision. This is a temporary to try to get these factories built, because there's a real push by this administration to bring a lot of businesses home. and they're saying, hey, let's get these businesses back in here. So it's temporary through the end of 2029, or I think they said before 2031. So I guess I guess you could say through the end of 2030, you can have this production property. I believe it has to have started the construction before 2029. That's the only thing. It has to be put into service by the end of 2030.
Yeah, I think Toby, I think this was one where they said it applies after July 4th of 2025, which is when President Trump signed the bill, signed it into law, and so and before
Placed into service.
2031. Yeah.
Yeah. Definitely placed into service after the
Hmm.
bill, but I think you're looking at things that construction could have started. Again, the way this president works is he's like, so long as you did this, we're going to try to get you into this thing. And again, there's when I start the construction of it, and when I actually put it into service and start using it. And yeah, I know it's a nuance. We don't want to get too far into the weeds, but
No.
if you started building already and you're one of these big companies, or you started to build a manufacturing facility and you did it this year, there's a good chance you'll be wrapped underneath this law. I can write it all off. Let's go to a couple others. There was a cap on interest deduction. And again, we could get into the weeds so quickly. It's the difference between EBITDA and EBIT, right? Whether my cap allows for additional deductions or allows me to write off more. It's the 30% of EBITDA for tax years beginning 2025 and beyond. If you're getting hit by this, you have enough money coming in because you're paying huge interest rates. You need to have an accountant on your side going through this, because I don't want to get too far into the weeds on this. If you don't know
No.
the difference between
Yeah,
EBITDA and EBIT.
we could get pretty far in. I think for clarification, that EBITDA, EBITDA is earnings before interest, taxes, depreciation, and amortization. So it kind of just takes all these different numbers, puts it in, and then it puts a cap of 30% of how much you can deduct as far as the interest goes. Was
All it means
my
is that
take.
you can write off more.
Yeah.
There's less of a cap. So we like that, right? So we want to be able to deduct more. So it's just by excluding the depreciation and amortization. So we, I think it was coming back. I think that was the issue, is that we're coming back this next year. And so this just makes it permanent. We're going to go to you're going to have less of a cap. And then we have domestic R&D expenses being 100% deductible as well. So you're seeing kind of it's interesting. You're seeing these 100% depreciations popping up to incentivize companies to do research and development, to build factories, to buy equipment, to buy personal property for their businesses. And what they're doing, and the way that they're incentivizing, is saying, we're going to give you a big fat deduction right up front. So you're not having to spread it out over 5 years, 7 years, 15 years, whatever the case may be. You can write it off now. And so that domestic research, R&D, instead of spreading it out over 5 years, which is generally, it's 100% bonus, like right now. So it's, again, this is kind of like bonus depreciation for research and development. So again, you don't have to wait the 5 million. I think that you can even amend, because the law, this isn't something that was set to expire. This is what it is right now. I believe that if your business is less than 31 million, I believe is the cutoff, then you can go back and amend your returns. And actually, you might have been deducting these things over 5 years. And so if you do have research and development software, things like that you're creating, it's all the time and expense that those folks were spending on it, the salaries and everything that was involved. It could be a sizable amount. And if you were spreading those over 5 years, I mean, just think about this. You're paying somebody payroll today and you can't write it off. So if that was you and you were hit the last couple of years, you can go back and amend and write those things off.
Yeah, Toby, I think this is one of the only ones that's the only new provisions that is this retroactive going back to 2022. So most of them, if they're going to be retroactive at all, it's going to go back to January 1 of this year of 2025,
Yep.
just because the law was enacted in July of 2025. But this one, if you can go back and amend it, I mean, you may be getting a refund with interest for a couple years from the IRS. So if you can get more money back and it works in your plan, man, go for it for
Yep. And
sure.
this is again a incentivized research and development spending people to go forward and invest in their businesses. And again, one of those weird cases where they said you can go back. And I remember this under the CARES Act when they did the bonus depreciation and made it a carry back. We saw that in Obama's major legislation as well. In fact, I think Trump's tax returns one year, he had about a $90 million deduction as a result, where you could carry it back 3 years, 5 years under the CARES Act. Um, we're not seeing it go that far. Like this is about the only thing I saw where it reached back and you can go through and amend. But when you see that, you pay attention to it and say, what are they trying to accomplish? What they're trying to accomplish is to give people additional funds to invest in their business, to grow their business. And what that is, hey, we're trying to grow the economy. We're trying to grow our GDP, which is interesting because that's what you need to do, especially if you want to get out of a hole like we're in with $37 trillion of debt as a country. One of the ways you get out of it is you have success and you grow your GDP and you make that a small number compared to everything else that's coming in. So I thought that was of note and certainly interesting. Um, Another big one was the excess business loss limitation. I'm not a big fan of this, but if you're an individual that owns a business like an LLC, partnership, sole proprietorship, whatever it may be, you might have a year where you lose money tax wise. Maybe you're actually losing money, and it's more than your other income. What the excess business loss rule do is it limits how much of those business losses you can actually use against your non-business income. In other words, we take all of our businesses that we have and we aggregate them all together. And like again, so if your other types of income might be interest, dividends, your spouse's salary, your wages, and it limits how much you can deduct against it. And there was an 80% limitation and there was a cap amount. And I think in 2025, the cap is $313,000 for single filers and $626,000 for married filing jointly. So let's just say that, hey, I made a whole bunch of money over here in my wages. I make $1 million a year and I create a loss. I use the short term business loophole and I create a loss of $1 million. You're going to be limited, saying you're married, to 626,000. So what's going to happen is you're going to use a deduction of 626,000 against your million. So you're still going to pay tax on 300,000 and some change. And then it's going to carry forward. The amount that you don't get to deduct is going to be used in future years, and it's going to be capped at 80% of that income. So those things are there. That's how it works. And I try to give you an example. Somewhat, I don't know how realistic it is, the $1 million salary, but let's just say that, yeah, you lose. Give me another one. Let's say you lose $1 million in your business. You have some massive deductions. Maybe you're doing a real estate professional and you're building a self storage and you get a big deduction, but you have $500,000 of other income, including your spouse's salary and dividends. Then you can only deduct of that $1 million loss 626,000. So you'd have a remaining, what would the number be? 374 would be used in future years.
Mm-hmm. Just one point on that is that 374,000 has to go forward. So we just talked about some losses going back to 2022. You can amend your return and maybe get a refund. That does not work here. So if you have, like in Toby's example, where we could take 626K and we've got 374K that we couldn't use, that 374 then goes into 2026. And if it can be used all or part, then it just keeps going forward till we get it used up. But yeah, I don't like these excess loss limitations, whether it's on the flow throughs,
I'm not a fan of them
you
either.
know,
I
or
always
the
think
C
they,
corp.
yeah,
You know, I mean, on the C corps, you think, well, I lose 100,000 this year and I make 100,000 next year. I don't pay any tax next year. And it's like, no, that's not the case, because your $100,000 loss is only worth 80,000, and you're going to pay tax on 20, and whatever. So
there's a limitation on that, the
yeah,
80%
just
carry
just get in the mindset that not your all of your losses are not necessarily going to be deductible in the year that you incur them.
That's what Congress does. Sometimes they complicate things that affect so few people.
Yep.
But again, they're playing with numbers, and sometimes they get a little too creative, and they're hurting folks that I don't think they intend to hurt. But yeah, not my favorite, but it's permanent, so it's going to be with us. It's indexed for inflation. I think it was set to expire in 2028. This wasn't one that was going to expire next year, but it was definitely going to expire. And now it's just there for, it's just going to keep going on. Um, Another one we talked about earlier, which I do want to get into, which is that SALT limitation workaround. So the SALT deduction, as Scott, you pointed out well, is it went from 10,000 to 40,000. And there was a bunch of different provisions floating around, and the one that we ended up with is um, 40,000 with the phase out. It's never going to go below 10,000. So, if you're a high income earner, it's 10,000. If you're everybody else, it's 40,000. But there was a workaround that the states created when it was 10,000, which was to allow the entity to elect to deduct or pay the taxes at the entity level, and then they deduct it. So it's a deduction to the entity. It's not a deduction to us. We have a SALT limitation. If we itemize, it's going to be somewhere between 10,000 and 40,000, and it does not exist for a flow through entity for state tax purposes. So if you're in a state that's a high income tax state, you're an S corp or a partnership or one of these, then it makes sense for the entity to elect to pay it uh, rather than the individual. And the reason is because it allows you to take the deduction to lower the income at the entity level, so that the entity that, or the income that then flows through, is less when it hits the tax return. So I'll use an example. I tried to come up with a couple. But let's just say, without that workaround, let's just say that you have an LLC and you earn $500,000 in net income, and you live in California and you pay $50,000 in state taxes. Sorry, Scott, I could have made it Colorado, but I didn't want to make it personal. Um, when without the workaround, you have a $40,000 limit. So let's just say that that's your total income is the 500,000. You get to write off 40,000 of it. Congratulations in your itemizing. So you're taking that deduction. There's $10,000 that's not deductible, and you're in one of the highest brackets, so it's going to cost you some money. That $10,000 might cost you lose you tax savings of 3,000 bucks, right? It's and it would have been enough to pay for your return probably. With the workaround, now all I do is I simply say, hey, LLC, you pay the 50 grand. Okay. LLC cuts the check, pays the 50 grand, deducts it as a business expense. Now you get 450,000, and you could actually do now, depending on your situation, maybe you're going to take the itemized, the standard deduction as opposed to itemizing. But you don't have to pay tax twice on it, which is great. So you're getting a nice little benefit there. That's a big one that I don't want to miss. Not enough people know about it. Not enough people do it, in my opinion.
Yeah, I agree. I see this missed all the time. And the other thing too is when in this case, well, this year before this law was passed, the $10,000 cap was real easy to hit. And it doesn't take a whole lot of income to do it, depending on what state you're living in. But if I had $15,000 of state taxes and I couldn't use the other five, I lose that. And I think that's the real big thing. It's not like, well, I'll just carry that forward, or I'll carry it back, or whatever, and I'll get the benefit. It's just a timing issue. It's like, no, if the cap is 40,000 and you got 50,000, that $10,000 uh, overage there is gone for tax purposes.
Absolutely. All right, let's do two more things, and then we can talk about some of these things that they eliminated out of the bill with regards to the energy. But let's talk about if you're receiving 1099Ks, 1099 NECs, 1099 MISCs, miscellaneous. These are changes that are now permanent, but there was all this confusion every year about reporting and about PayPal and all these companies. Sometimes it was even Home Depot. Are they going to have to report how much you gave them? And is it going to be a really low level of $600? And so what they did is they said basically the 1099Ks are reverting to the old rule. This is your PayPal's and payment processors. You're only going to get that 1099K if you have over $20,000 of transactions. And this is a big underline the and you have at least 200 transactions a year. So like you got to have a lot of business coming through. If you have more than $20,000, but it's 10 transactions, they're not going to give you a 1099K. Now you're still required to report it, but this was causing anxiety to everybody. They were thinking that they were going to be getting this thing. And then the other one is on 1099 miscellaneous and 1099 NECs. The threshold was $600, and that was what was driving everybody nuts. It's going to go up to $2,000. So you're not going to be having to issue or get and receive these 1099 NECs and miscellaneous unless you're over $2,000, which is going to save people a lot of time. Because I know we do these every year for our clients, and it's just a pain. People get these things and they're like, wait, this is incorrect, or they're having to pay all these things out. So what they did is they made it a little bit easier. The big one was that 1099K, because I could just tell you that so many accountants were freaking out on that. So many people were mad and upset, and they were like, oh my gosh, you're going to be getting a tax form. You're supposed to report it anyway, but of course it causes you to get a little anxiety when you're like, wait a second, why are they giving me them reporting this income? This isn't what I did, or this is what I spent on, or this wasn't even my money, or whatever the case. It's just easier for you if you don't have it reported.
Yeah, I think this was a compliance issue as well, right? That $600 on the 1099 miscellaneous or the 1099 non-employee compensation, that was never indexed for inflation. So it's been $600 for seems like 500 years now, right? I mean, a long time, and so now jumping that up to 2,000 just helps small businesses, or bigger businesses where you don't have to send out all these 1099s. And I believe they indexed the 2,000 for inflation
They
too.
did. They absolutely. So it's permanent.
That was
Otherwise they would add it. Yeah.
Yeah, that was one thing I wasn't really sure of, so I didn't want to make a definitive statement on that. But that could be 2,100 next year or something. So at least we're going to see some progress, because the $600 back 30 years ago isn't quite the same as it is today. So as much as I didn't like what we were talking about the last time, this is the last issue. This is one I do like, is that it just takes away some of the paperwork that a small business has to do.
Yep. All right. There's a couple more that I want to hit on. I just said it was a couple more, but let's talk about the employee retention credit, because man, this was during COVID, if you kept employees, you got this credit, and then everybody and their mother came out on the internet and on radios and on TV and said, "Oh, you're eligible for this," and it was a bunch of fraud, and it was hogwash. So the first one is retroactive. All claims are denied after January. That if you haven't made a claim for 2021 to 2024, if you have not made a claim for the employee retention credit, I think refunds are now going to be denied for all claims made after January 31st, 2024, period. Done. If I think the claims made for the third and fourth quarter of 2021 filed after January 31st, 2024 are retroactively denied, even if they were timely made. So this is kind of nasty, right? If you're one of those people, your claim's done, unless you have a pending claim or something that was affected by something that occurred after this law. And then also the IRS can audit you longer. It used to be a 3-year audit period, and what they did is they said there's so much fraud, we're going to give you up to 6 years. And so this is Congress exercising its muscle to say, we haven't gotten to you yet. But if you're one of those people that just claimed an employee retention credit and didn't have employees and you're playing games, or you didn't meet the qualification, and you know who you are. You had somebody saying, "Hey, I'll get you this credit, and I'm going to take a percentage," or who's usually a high fee. Then they may get to you. They might, and then they've increased the fines. I think it's $1,000 per violation, and 75% of the income. So if you got yourself a big fat check and you know you don't deserve it, you may want to be going back and fixing that as quickly as humanly possible, because if they catch you, the penalty is pretty severe. It's going to be a big chunk of that. Plus, you're going to have to pay it back. Plus, you're going to have to pay $1,000 per violation. So I've seen some pretty nasty situations in this, Scott.
Yeah, I have two as well. And typically I would say, I don't like this. I don't like giving the IRS 3 more years to audit. And we're just going to deny claims as of, January 31 of 24. We don't care if they were valid or not. If you filed in February of 2024, you're out. But I have seen, and I've talked to several IRS people, attorneys and auditors and whatever, they are putting projects together on this, where they'll have teams where that's all they're doing for the next year is this retention credits or whatever. And so even with the IRS losing, a fair number of employees through the federal government and Trump's, some of his executive orders, I still think that the IRS is not going to let this one drop. That they are going to go after it because there's a lot of money involved. I mean, we're talking some of these businesses had, 6, 7 figures of credits available that, the government was trying to help people get going through COVID. And this is the way they did it. But of course, some people who don't qualify took a chance anyways. And that's what the IRS is trying to weed out.
And it's kind of sad. I mean, this is a tax credit. That's why they were so potent. It's dollar for dollar. It's not a deduction. So it's not like they're saying, hey, I'm disallowing your deduction. What you did is you took dollars directly out of the treasury, and a lot of these folks didn't qualify.
Yeah.
Again, it was COVID area. You think about this. We're going back a lot of years. And if you kept your staff on, even though you were shut down, this is what the tax credit was there for. It wasn't just to incentivize businesses. It was to, hey, if you don't terminate these people, we're going to give you a tax credit up to a certain dollar amount. And then afterwards, a bunch of promoters said, hey, we could say you are affected. It doesn't work that way. Right? So there's again, I've seen some pretty heinous situations where it's $300,000-$400,000 where people are just saying that they were affected when it didn't affect them at all. In fact, their business increased, and they didn't have an effect of the shutdown, which is not what that was for. There's so much of it. When you see the IRS, or when you see Congress extend a statute of limitations, because there's so much of bad actors and so much bad of something, that's pretty unusual. So that's what we're seeing here. Other things that are permanent that I want to talk about real quick is the elimination of a bunch of clean energy stuff. Like you saw basically this administration come through and say, whoosh, there are for the car credits for your Tesla, gone. You have a little bit of time. I think, what do we have up until the end of September? So you have until right at the end of this of September to go get your Tesla. I mean, your energy vehicles, EVs. Putting solar on your house. I think you have until, I don't know, I think it's the end of the year. Solar on your rental properties. I think you have until the end of the year to get your tax credit, the 30% tax credits. Again, these are really potent because you're getting a deduction and you're getting a tax credit. There's getting partial deduction because you take half. There's a calculation there, but you're getting some pretty strong incentives that are going away now. They're gone. They're going to be gone. You have a little bit of time to take advantage. So if you're going to do the electronic vehicles, you got to come in and you got to get them before the end of September. Otherwise, and take delivery. I don't think it's ordering. I think you have to take delivery before the end of the month. Otherwise, you're not going to get it.
Yeah, I think this is sort of the anti-Elon Musk provision here, right? Where he said he didn't care much for this bill, and this is one of the reasons why that, you go out and I think you're right, Toby, that you have to take delivery, kind of put it into service before September 30th of this year. But, my advice here is that if you're going to do anything on the quote unquote green energy, clean energy, whatever you want to call it, you need to do that this year. I mean, that's a drop dead date. So if you want to put solar on your house, you got a rental property, you want to put some solar panels on or whatever, you've got to do that before the end of the year. And certainly the
Mm-hmm.
car is even a bigger issue because we only have till the end of September. So you buy an EV in the fourth quarter of this year, no deduction, or excuse me, no credit for the clean energy here. So this is something that it's coming up, and if you're considering, buying an EV or doing solar or some other clean energy, the time to do it is now. Don't wait.
And I think that there's two that we have to pay attention to with regards to real estate as well. Um, Number one, beyond the solar, but
Yeah, I
if you're
think,
doing an energy efficient building, I think it's 45L. And I know our friends over at Cost Seg Authority and Eric Oliver do a lot of these, and the 179D, the energy efficient deductions are affected by this.
mm,
The 45L, I think, are gone. And I would say to anybody who's a builder, and you could get a $5,000 credit for creating something that's energy efficient, is you're going to talk to whoever it is that you're working with on those to make sure that you can know if there's a way to preserve any of it, that there's something that you could do. In 179D, they got rid of residential and said it's just commercial, which is, again, it's a deduction for energy efficient, um, like lighting, HVAC, insulation, things like that. Um, that is now restricted to commercial properties only. And again, in a housing crisis, I don't understand these, but I mean, I guess it's, I think it was a reaction of throwing out babies with bathwater, probably why Elon Musk was like a little bit frustrated. Is I get that you want to promote fossil fuels and things like that, but why do you get rid of these things? These are energy efficient homes. It's going to save people money in the long run, where they're not paying as much in utilities. And it seems like you just, took away some of those incentives. Again, I get it, but it's not my favorite.
yeah, it's not my favorite either. And I think, one of the reasons they did it, and one of the reasons I'm not a big fan of this bill, is because of the amount that it adds to the deficit. And so I think they were looking at some revenue raisers, to be able to offset the tax deduction cost of the government here. And this is one of them that they said if we get rid of, this 45L or 179D or all these different sections of green clean energy incentives, we'll be able to save X billions of dollars. And I think that's why they did it. But again, if you're trying to incentivize it and then you're going to take away the credits, you're taking away a lot of the incentives. So we'll see
Yeah.
what ends up happening. It may come back, it may not.
I would guess that it comes back in some because again, it feels like they cut a little deep on it.
Yeah, I
So
think it'll come back as well in some case. Too, the other thing that I wasn't real sure about what they were going to do with this, with the new bill, was the opportunity zones. That was something that, that was put in to encourage people to invest in economically distressed areas or whatever, where we want to
that
encourage investments. And I thought, well, what's going to happen with the op zone? I mean, what are they going to do? Are they going to make that permanent? What's going on?
well, they did make it permanent, and what was happening? It was going to end at the end of 2026. Not opportunity zones as a whole, but the ability to roll and defer capital gains into them, and then start a new holding period and have a step up and all these things. If you remember, in the Tax Cut and Jobs Act, you had this. Hey, if you could roll qualified capital gains into a qualified opportunity zone, you do substantial improvement on the property, you meet the requirements, you're deferring the tax on that roll for a period of years until 2026. So what they did is they extended it, but and you had a step up in basis. I think it was 10% in year 5 and another 5% in year 7. So there was some, hey, even though you're going to have to pay tax in the future on this, you're not going to pay as much. And what they did is they made a rolling 5-year stretch where you could still put money into these opportunity zones, and you don't have to pay tax on that rollover. It's going to be a period of years. So in this case, I think it's 5-year rolling forward. There is 1 year this year where I think you still have the deferral being taxable in 2026. So we're going to be in a transitional period. Now, people always ask, like, why would I do that? I'm just deferring it. It's not like a 1031 exchange where I don't have to pay it unless I sell. I'm just deferring this for a period of years. And again, if you do an opportunity zone this year, you might defer it for 1 year. Next year, it's not even really that. What happens is if you hold that property for 10 years, then you could step up its basis, including its depreciation recapture at any point. I think it's year 10 through 30. You could step it up at any point and not pay any tax if you sell it. So what happens? I roll $500,000 of income of capital gain into an opportunity zone. I do some substantial improvements to it, yada yada yada. Maybe I'm $1 million into this thing, and I sell it for $5 million in 10 years. I'm paying tax on the $500,000 along the way. In this particular case, in 2026, I would have a taxable event, and I would have to pay a little bit of capital gain on that. But then the rest of the growth. So let's say I put $500,000 in, put another $500,000 of improvement. So I have $1 million basis and I sell it for $5 million. There's $4 million that I would not have to pay tax on. And that's why people like those opportunity zones. What they've done now is they've said, hey, we want to bring back the step up in basis. So after 5 years, you get a step up in basis. So let's use that same scenario. I put $500,000 into a property that qualifies, and I would have to pay tax on that $500,000, step up basis of 10%. So I'd only have to pay tax on 450,000 of it, and any of the growth over that. So long as I hold it for 10 years, I could step up and avoid tax on the depreciation and the growth. So again, I'm just using how much I rolled. Maybe I bought a property that was worth $2 million. Right? Maybe I levered it and I borrowed, and then I met all the improvement requirements, and I held it for at least 10 years, and I depreciated the heck out of it and got a bunch of tax write-off as well. I would have a very small amount of tax in year 5 with the step up, and then I would pay no capital gains or depreciation recapture thereafter. That's why people are so interested in that. And they even added another category, Scott. These rural opportunity zones, qualified rural opportunity funds. So QROFs, I guess. I don't know what somebody's going to call it, but yeah. You get a 30% step up in 5 years instead of 10%. So again, you're going to have taxable event. Let's say it's $500,000. Your step up is going to be 30%. So 150,000 is not going to be taxable. You'd owe tax on 350,000, and you don't have to do the substantial improvement, which is 100% of the improvement value, is now only 50% of that improvement value. So they're going to designate these rural areas where there's even stronger incentives to get some economic development. That's what these things are for. And by the way, under the original Qualified Opportunity Zone under the Tax Cut and Jobs Act, there was no zone redesignation. Now they're going to do it every 10 years. They're going to go through and redo the qualified opportunity zones, which is, again, it's a big one. It's right. If you're in a qualified opportunity zone, you don't lose it, but you could see other areas designated for qualified opportunity zones, which is pretty impressive. And this is permanent. This is no longer a test case where they're looking and we're all playing around with this, trying to figure it out. Now we've had a number of years dealing with this, close to 10 years, and people are getting more comfortable with what these things do well and what they don't, and how to take advantage of them. And I think you're going to see more folks focusing in on these opportunity zones, because as they exit some of these high appreciation zones, which the real estate's just skyrocketed in the last 5 years, last 10 years, it's just gone crazy. You're going to see people now feeling better about exiting some of those, knowing that they can push it out into another opportunity zone. And now you could be rolling out of opportunity zones as you improve, and continuing. Hey, I have a taxable event. I'm going to roll that into another one. Hey, I have a taxable event. I'm going to roll that into another one. So these things are going to be something to watch as they continue to progress.
Yeah, I like them. I like the op zones because if you can use them the way they were intended, you can get some really nice tax benefits. But, I've had people say, well, I'm just going to do a 1031 exchange. I can accomplish the same thing and I got more investment vehicles, because I don't have to go into a distressed area or something. And I'll back them up and say, wait a second, they're not the same thing. That, your
Mm-hmm.
1031 exchanges, you don't get a step up in basis, right? The only way you're
Yep.
going to get a step up in basis if you keep doing 1031s is for you to die, right?
Yep.
Then you can get the step up in basis through the estate tax and whatever. But these qualified op zones are giving you the opportunity. They're saying, look, if you take, let's say, using Toby's example, I got a $500,000 capital gain, and you go into your tax professional and they say, well, you're going to owe $100,000 in tax or whatever the number is. It's like you want to know that before you make the sale, so that maybe a 1031 is what you want to do, or the op zone, right, where you can have this step up in basis as you hold the investment, and then potentially avoid the capital gains on the backside as long as you satisfy the holding period. So, if you're looking to invest in one of these lower economic areas, you may not decide to go with the op zone, but by all means consider it. At least look at it, run the numbers, and see. Maybe it's a great situation for you, maybe it isn't. But don't forget about it, because it's really really an important way to control your capital gains.
Yeah, it is a nice exit. Again, using that example, you'd have paid 100 grand, and let's say that in 12, 13 years you sold that thing and there was $3 million a gain. You would have been glad you paid the 100. You'd have been fine if you paid the 100 at all, because you could potentially roll that into another opportunity zone. So
Yep.
it's, and you're going to avoid a tremendous $3 million of tax free plus depreciation. It's not even close. So if this is something that's of interest to you, make sure that you have an accountant on your hip that understands it, because it could be pretty potent. All right, moving on, because again, we'll be here. We'll talk all day, guys. Um, is the new markets credit, and it's a federal program that gives credits, tax credits, to investors who put money into real estate projects or businesses in low income neighborhoods. It's been there for before and what it is it's making it permanent. And let's just say that an investor puts in, I'm just using a large number just to make it, because this is where these things tend to go. Let's just say they put in 10 million into a health clinic or affordable housing in a low income, um, in a neighborhood. They could be given a sizable amount of tax credit. It could be, in some cases, let's just say they got a 39% tax credit over 7 years. That means they're going to get, that in that case would be like $3.9 million in tax credits. So there's some strong incentives on these. But what the Big Beautiful Bill Act did, one Big Beautiful Bill Act, was made it permanent. They also made the corporate charitable deduction permanent and added a little floor. And we talked about the floor. Scott, you did a good job talking about the floor on the individuals, and the individual charitable deductions. The higher amount, I think it's 60% for individuals. It's 10% for corporations. But what they did is they said the first 1% you don't get to deduct. So if a corporation, let me use an example, makes $1 million a year, the first $10,000 of charitable donation, it's nothing. So if you donate $5,000 to the local charity, you get zero deduction. If you donate 50,000, then you'd get to write off up to 10%. So $100,000 is the cap. You're well underneath that, but you lose the first 10,000. So if you gave $50,000 to charity, you would get a deduction for $40,000. The first 10,000 would not be a deduction. So if I gave 50, I lose 10 because of the 1% floor, but I would end up with a $40,000 deduction, which is far more generous than it used to be. But that's permanent change under the Tax Cut and Jobs Act. This amount was 10%, and it's encouraging corporations to be charitable, but it's also creating a floor saying we're going to let you deduct anything other than that first 1%. After that 1%, then you can then be as generous as you want. You can write it off. But if you're underneath that 1%, we're not going to give you a deduction.
Yeah, I think, too, with the charities where you may be able to get a personal deduction versus a corporate deduction, you may want to look and see, what's the difference if my corporation makes a $50,000 donation or if I make it. There may be maybe some differences there with the floors and ceilings and the 10% or whatever, but it becomes really just a math problem. So just plug in some numbers, look at what your floor is, look at what your ceiling is, and then make your donations. If you're going to look at the tax component of the donation, look at it and see what makes the most sense.
Yep. And then let's go over there's just a few more, and then we've beaten this dog
Yeah,
sufficiently.
I think
Right?
we just have a couple more of the employer credits. Some of the
Yep.
bennies and what have you that they pay out this year or next,
The
what have you.
the big one, and this is a permanent change, is the employer provided child care credit. So that's if I think it's permanently increased to $500,000 for certain taxpayers, $600,000 for small businesses with an annual inflation component. So whenever you hear permanent, you got to just kind of assume that there's an inflation rider because they're not going to. It's not a small period of years where they give you something, but you get a 25% tax credit. And when I say tax credit, understand that's dollar for dollar. It's not a deduction, but you get a tax credit for operating on-site childcare or contracting with a licensed care facility for your employees to provide that service. So if you're spending $500,000 on your employees to provide care, you would get a 25% of that, so $125,000 tax credit. So yeah, it costs you a chunk of money, but you're getting a tax credit. The government's basically saying, if you're willing to do this, we're going to cover 25% of it. There's a drop down if you're doing child care referral, resource and referral. I think it's 10% of that amount. So there's still some benefit towards that cost, but it's not as much as if you decide, hey, I'm going to do one of two things. I'm either going to provide child care at my facility, or I'm going to contract with child care and provide it through a third party to provide care for the employees. The next one, let's just say paid family medical and leave credit. This was brought in. I think this was brought in during CARES, if I'm not mistaken. I can't remember whether this was the CARES Act or whether this was a different one of the reconciliations during COVID, but there was paid medical leave and family leave, and maybe I'm wrong on both those accords. Some of you accountants out there that follow this more clearly, maybe it was something else, but they made it permanent. So it was definitely under the Tax Cut and Jobs Act. It was definitely something that was going to go away, but you get a credit. I think it's between 12.5% and 25% of the wages paid while they're on qualified leave. And what is qualified leave? Sick or family leave that the employer is paying for them basically to take that leave. And it's the government basically saying, hey, I'm going to assist you. And then there was a last one, is the employer student loan repayment. God knows we have a lot of people right now that are behind on their student loans. They thought they were going to get forgiven. They weren't forced to pay. They get out of the habit. And there's a loan payment exclusion. I think it was around $5,200. They made it permanent. They made it permanent at that 5,200, except it'll be adjusted for inflation again. So whenever you hear permanent, you got to assume that there's going to be an inflation rider. I think the inflation rider doesn't kick in for a couple of years until 2027. So right now, I think it's 5,225, so 5,225, where the employer could provide that to the employee for their student loans, and the employee doesn't have to pay income tax on that money, and your employer still gets the deduction. So it's basically like them handing you $5,250. I think there's still employment taxes on it. I'm not 100% certain on that one, but I know it's excluded from federal taxes.
Yeah, yeah. You don't, I mean, again, that could be one where you may have to pay on the state level, but not on the federal level as long as it stays
Yep.
under that 5250. But again, that's something where, let's say it's 5 grand, my company pays it out, it gets a $5,000 deduction, and I don't pay income tax on that 5 grand. So we got a double winner there. And if we can get a deduction without having to pay tax on the flip side of it, really nice deal. So if you qualify or your employees qualify for this, definitely something to take a look at, because
Yeah.
they can exclude this money. It's not a grand slam, right? You're not going to be able to retire if you don't have to pay tax on $5,200. But with the tax planning, we want to take everything that we can do, everything that we can use, to reduce our taxes by $5 here, $10 there, and the next thing you may have a real nice tax savings. So, yeah, if you qualify for this, go for it.
And it's an incentive for an employer to give to an employee. Again, it's just making it more competitive, and without having, it's an immediate benefit to the employee so that they can go ahead and pay their student loans, or that your employer's paying a portion of it, to where there's not a withholding component, because otherwise you would have to withhold on it, which is kind of a pain. I think you still have to run it through payroll. It's still a benefit, but it's not subject to the employment or to the federal taxes. You might still get hit with tax and employee and old age disability and Medicare or employment taxes, but it will not be subject to your federal income tax withholding, which means you have a little more money now, and it's not going to be included in your tax. So what does that mean? It means, hey, more money now to pay something, so that hopefully it gives you a little bit of relief, folks relief. And it also allows an employer to differentiate themselves from their competition by helping employees out. Again, if you look at those last few things, medical leave, hey, we're going to pay that. Hey, let's help the employee with their education expenses. Those are incentives to keep and retain great employees. And if an employer is willing to be generous, the government's saying, if you're willing to go into your pocket, I'm willing to assist. And that's
Yeah,
all it is.
yeah, yeah.
And
These are great benefits as far as that, and I look at it the same way, as far as it incentivizes employers to really try to keep their employees, right? That you don't want to have to go out and interview a bunch of people and do whatever. Here you've got these employees, and it says, look, we'll cover your health insurance and we'll give you some vacation, but we also have this child care. Nobody else has that. Or we have this medical leave, or look, we'll give you 5 grand a year on your student loans. So all of these things that can tie into your employment to make it more attractive and more likely that you'll stick with the employer, and so they get tax benefits. And if the employer gets them, in this case, so do you. You're not going to be paying tax on it.
let's look at what it is again. This is a big old financial tax act. It's a lot of different things. It's budgeting. There's a lot of moving pieces in the one big beautiful bill act. It's complicated. It's long. We just went and spent a couple hours going over all these different provisions, both on the personal side, the business side, and we didn't dive into the whole act. So it is one of those pieces of legislation that's going to take a long time for people to digest. I hope that you have a takeaway from this, is that you're able to go through and find things that are relevant to you. You can go back and listen. In some cases, you heard Scott and I say, we don't know yet, or we will wait for interpretation, or there's some gray areas. You saw that. That's because with a lot of these things, they get written and then they get interpreted. There's going to be courts arguing over things. You're going to have regulations issued by the IRS on certain things. And so all this is great mind food to know. Here's some incentives that Congress has put out there, and gravitate towards those incentives. There's some big ones that are action items that are absolutely like, hey, we know how this is treated, the qualified opportunity zones, the bonus depreciation, all the individual tax incentives, and additional deductions, and ways to get some tax relief. Those ones, and then there's some ones where you're like, okay, we're going to have to wait and see what they kind of say and how much this expands. But at the end of the day, that little bit of knowledge can save you a lot of money, and it's your money, and it's putting money in your pocket. Maybe it's putting money in your employees' pockets. Maybe it's allowing you to do projects that you otherwise wouldn't have been able to do. But that's what these things are there, is to incentivize certain behaviors. And so hopefully we helped you with that. Scott, any parting words?
Boy, there's a lot of stuff to learn here. I think just keep in mind that what we talked about today is going to change, right? That IRS will issue some regulations or revenue rulings or what have you. The tax court, if you claim one of these deductions in 2025, you file that return in 26, it's going to get to court in maybe 2028 or 2029. So some of this stuff, just like the last Tax Cuts and Jobs Act, we had to wait a little bit. We have to do some interpretation and figure out what's going to be best for us. So I think, like most everything else with taxes, education is key. Know what provisions potentially will affect your family or your business or investments. Focus on those and make sure you have a tax professional that's up to date, that knows this stuff, so that you know come April or May or whenever you're going to do these tax returns next year, you've got a plan in place, because you got to do that now.
Perfect. Thanks, Scott. I really appreciate it. And I hope you guys got something out of this. Share, like, subscribe, and put in your comments what are your favorite provisions here, or what do you wish they had put in that you missed? And we'll see you later.